If you're a business owner and you're making a good amount of money, there's a solid chance your CPA is costing you more than what they're actually saving you. And most business owners don't even know about this. So here are the 5 signs. Even if you know 2 of them, then you definitely have a problem. Here's what most business owners don't realize. Your CPA does, I would say most of the time, one job. They file your taxes. But there's a completely different job that almost nobody is doing for you. I can bet money on that. Is that no one's really planning for your taxes. Filing and planning are 2 very different things, and most of you probably only have one of them. Let's be clear, your CPA puts numbers in boxes. A planner tries to keep more of your money in your pocket. 2 very different jobs, and you see this all the time with business owners. They'll come in, they've had their CPA for 5, 10, 20, 30 years, and they have no idea how much they're overpaying. And I want to be clear about this, is that it's not that their CPAs are bad. They're great CPAs and great accountants out there. They're really good at what they do. It's that nobody is doing that second job, which is the planning. And if you think a financial advisor, a financial planner will help you with the planning, well, good luck with that, because financial advisors know nothing about business owners. So anyways, here are the 5 signs that your CPA is costing you money. And again, not because they're bad at their job, but because you're paying for filing when you actually need planning. Sign number 1, they only talk to you during tax season. If the only time you hear from your CPA is between January and April, they're likely just filing your taxes. They're not planning for your taxes, and there's a huge difference between those 2. A planner, I would say, meets with you quarterly at a minimum. They're projecting your tax liabilities in July, and they're not discovering your tax liability in March or April when you're actually filing them. They're doing that way beforehand. By the time you're filing, most of these options have already expired. So if you think I'm going to wait till April to do the tax planning, it's way too late. So every month without a plan is a month where you could potentially leak some money. So let's speak conservatively. How much taxes are you wasting per se, or overpaying the IRS every year? I would say without planning, anywhere between $5,000 to $20,000. And obviously this depends on your income, but this is for a business owner earning somewhere between $250,000 and profits all the way to $1 million. Again, each business owner is very different, and your circumstances are very different. But let's go through some strategies here that expire, that have an expiration. If you think you can do that in April, it's too late. So think about a solo 401k. That plan has to be established by December 31st. You can't open one in April when you file and backdate it. So let's think about another one, Section 179, equipment purchases. The asset has to be placed in service before the end of the year. Why do you think a lot of business owners like to shop for new cars in December, right? There's a lot of good deals going on because they can typically bonus depreciate them, right? If you want to buy a truck in January, well, you missed the full year's deduction. You have to wait till the next year. There's a lot of things that has to be planned before December. Once the year closes, your income is pretty much locked in. There's not a lot of changes you can make. Think about estimated tax payments. There's quarterly deadlines, right? There's Q1, Q2, Q3, and Q4. If you miss all of them, there's penalties. Even if you don't owe at the end of the year, all of these have hard deadlines. And again, if your CPA only shows up in tax season, every one of them is pretty much already gone. Sign number 2, they've never talked to you about your entity structure. Let's say you're making $250,000 in profit, and your CPA has never asked you whether your LLC should actually be taxed as an S-Corp. That's a very expensive strategy there that he should bring up to you. Let me quickly explain this. Sole prop versus LLC versus S-Corp taxation. Here's the 30-second version. I have a whole video on this if you want to take a look at it. I have an S-Corp strategy. The salary versus the distribution split. As a sole prop, you have to pay 15.3% of self-employment tax on everything. 100, 200, $1 million, you have to pay 50.3% of that. As an S corporation, only on your salary. Again, so if you have an S corporation and you pay yourself a W-2, you're only paying self-employment tax on that salary. The rest flows through what's called a distribution as a K-1, also known as book income. At $300,000 in profit with $150,000 in salary, that $150,000 K1 bypasses this self-employment tax, which in turn can save you, let's just call it $23,000 saved every single year. So entity structure should be reviewed every time you cross a major income threshold. And let's just say $100,000 is one, $250,000, $500, $1 million, right? So on and so forth. So if your CPA, set up an LLC for you 5 years ago when you're making 80 grand and you never revisited that specific structure when you're earning $300,000, well, there's your sign number 2. So let's say, what are the tax savings at the $250,000 profit level? It's hard to say. Again, depends on your situation, but I would say somewhere between the 15 all the way to $40,000 a year. And obviously this compounds the more money you make. And if nobody's told you this in 3, 5, 10 years, that could be $60 to $120, $200,000 in taxes that unfortunately you've already lost. Sign number 3, they can't tell you how much they saved you last year. Here's a test. Call your CPA or tax professional whenever you talk to him next time and ask him, how much did you save me last year? And if they can't give you a number, well, then there's your answer. This is the simplest sign on the list. One question, one phone call. A good planner will say, I saved you $10,000 or $15,000 through this S-Corporation strategy. Also, we did a solo 401k plan. We did a SEP IRA. We saved you $5,000 there. So a good planner is the one that tracks the value they create for you. If they're just filing your tax returns, they're not measuring it, then they're probably not doing a good job. Here's the thing. You literally can't know what it's costing you. And that's exactly the point. If they can't quantify their value, you can't quantify your loss. Hey, just real quick, if you're watching this and you're thinking, yep, that's me, I need a quick 30-minute consultation with this guy, there's a link below. Grab 30 minutes with me. It's completely free, no charge, just 30 minutes to see what we can help you with. All right, let's go on to sign number 4. Sign number 4, your tax bill hasn't changed in 3 years, but your business has. Your business has grown. Maybe you went from $150,000 in profit to 400 to 500, whatever that number is, but your tax strategy hasn't changed at all. You're paying the same way you always have. Nobody's adjusting anything. The tax playbook at $100,000 in profit is completely different from someone who's earning $250,000 or $500,000 who's profiting $1 million. And quick note here, guys, when I say 250 or 500, I mean in taxable income, not in gross, right? We don't care about gross. We care about the bottom line, because the bottom line is what's going to hit your taxable income, which eventually is going to go to your 1040, your tax return, right? So anyways, quick note there. But again, these are completely different strategies between 250 to 500K. As your income starts to grow, I would say new doors start to open. You have cash balance plans, you have defined benefit plans, income splitting, new strategies, state planning, right? State becomes a new thing. If you live in California, New York, Hawaii, these very expensive states to live in on a tax perspective, you have to understand that the more money you make, you have to start to level up your tax planning strategies. So a lot of these strategies probably don't make sense at a lower level. You don't really need them. But at some levels, as you start to make more money, some tax strategies actually start to close their doors. Think about like the QBI deduction. It starts to phase out, which is 20% of your business income. Obviously, if you're an SSTB or not, and there's that whole calculation. We're not going to get into that. There's a whole nother video on QBI. You should probably watch it. If you're in the trades or a contractor, you should definitely watch that video. But there's a lot of strategies that start to phase out. Certain credits disappear. Higher brackets eat into your income. And a good planner starts to adjust for this. And unfortunately, a filer is not even thinking about that. They're just thinking about putting the right things in the right boxes. So a good planner will say, hey, so-and-so, once you cross this $250,000 this quarter, here are 3 things that we need to make sure that we do before December 31st. And, unfortunately, a bad one probably won't even know the difference. And this strategy is actually the one that compounds every single year, right? A business that grew from, again, back to the previous example, $150,000 to $400,000 in profit. Restructuring that business could help you save $30,000 to $60,000 a year. Again, going back to that S-Corp example. And, $30,000 to $60,000 a year. That's not a rounding error. That's a whole down payment on a new rental property that you could cost seg down the road, right? So anyways, my point is, as you start to make more money, you need to level up your tax planning. Sign number 5, and it's the last sign in this video. They don't know your business. They just know the numbers. If your CPA has never asked you how your business actually makes money, they're just filing your tax return, then that's not really a strategy. A good planner understands the business owner's industry, whether you're in real estate, whether you're in construction, whether you're a doctor or dentist. A planner has to understand the ebbs and flows of the business, right? Again, does your CPA know how many employees you have? Whether you use contractors, whether you use W-2, what states you operate in, what equipment you're buying this year, if you're in a specific, just like I mentioned, you're industry specific. If you're in tax, do you have the R&D credit? Again, we just talked about Section 179 for heavy equipment, for, if you have to buy a truck or some sort of, drilling equipment. Cost segregations for real estate. Multi-state operations, if you operate in multi-states, that creates a nexus issue. Filing obligations in states you don't even know about. All of these are both a risk and an opportunity. And a planner who knows your business says, hey, let's make sure we push that truck purchase into Q4, right? When you have more cash flow. Or maybe they'll say, hey, you know what? You probably don't even need to expense this current year. Let's wait until next year to do that bonus because we know we're going to actually make more money next year, right? And unfortunately, I see this all the time, is that just the CPAs, they say nothing, They talk to you in March and they file your tax returns. And again, all these deductions vary, depends on your industry, depends on what type of credits you're taking. If you're taking the R&D credit, you can save a lot more than $10,000. But I think the point I'm trying to make here is that a good planner understands your industry, understands your cash flow, understands your employees or your contractors, and tries to plan around that. They just don't show up in March or April and just prepare your returns. So let's add all of these tax opportunities up so you guys can see how much we're missing every single year. So on sign number 1, there's no planning during the year. And honestly, this just can depend on what type of business or your income, but let's just call it $5,000 to $20,000. Sign number 2 was the wrong entity structure. And probably the easiest one to quantify is the S election or the S corporation. That can save you $10,000 to $40,000, again, depending on how much money you earn. And then signs 3, 4, and 5, I would say there's no quantifiable or measurable number, but I would say just those strategies will compound on top of the other 2. So for a business owner making $200,000 to $500,000 in profit, I see people leaving anywhere between $30,000 to $100,000 on the table every year. And not because they have bad accountants. Again, I want to make sure I emphasize that, but because they have a good CPA doing the wrong job. If you want someone to actually look at your situation, there's a link below. Feel free to get a 30-minute consultation with us. We'll tell you, straight up whether you have any savings on the table or if this is a good opportunity or not. I'm Steven. I'm a CFP and also an IRS enrolled agent, and this is what I do literally all day. Subscribe if you thought this was helpful.